Time for our weekly market review. We're going to review equity indices, of course. Then we're going to review Bitcoin, gold. We're even going to talk about a big loss I just took. And I know what you're thinking. AK, you never take L's. How could this be? No, the truth is Mr. Market likes to bend me over too. The only difference is that nowadays I enjoy it. And if you'd like to enjoy getting bent over like I do, then make sure you check out our free training. There's a link in this video and down below in the description and comments. And you'll see why with the right strategy, you're okay losing and you don't feel terrible. But we talk about that in this training and the strategy that I use and a bunch of our Fallible members use as well. But yeah, I'll explain more later in this video, but check that out. First up, let's take a look at Bitcoin. And you can see right here from this chart, there was a huge breakout. That was July 27th. And that's really how markets work. You can see there has been a compression for months now. This thing has been going sideways, compressing tighter and tighter. That's kind of how you want to look at charts when you're doing all this technical analysis, because there's no magic in these lines. You're just trying to figure out what the psychology is. But a general rule for markets is when you see a compression like this, a tighter and tighter pattern, it's just getting ready for a break in one direction or another. And that direction, you're not actually going to know. So you guys remember I was talking about a similar pattern forming in Tesla. This is just on a smaller scale. And we were talking about this in a previous video, how things were coiling tighter and tighter. Now I made the bet that Tesla was going to break higher, but what actually happened? They broke lower. After earnings, we had two pretty big drops. So yeah, I called the direction wrong, but like I said in that video, I wasn't placing a bet until the breakout happened, because even though I thought maybe it would break to the upside, it didn't. So in that case, I just saved myself some money. If I was playing it discretionarily, which, you know, I don't, because I stick to my system nowadays and that strategy that I was talking about here. But the idea is the same, compression and explosion in one direction or another. So you could take that same concept and apply it to Bitcoin right here, right? And this is even a better pattern because it's over a longer time frame. The longer out you go in time frame, the better the signal to noise ratio, meaning when you see a breakout, it's more likely to hold. Shorter time frames, you could see a lot of breakouts and a lot of them fail, but this is over multiple months, so it's stronger. And this breakout, you know, was just very strong here. So if you were a more cautious trader, you'd be waiting for this breakout and then you'd get in. As we say here, now may be a good time to put on a position if you don't already have one. That's if you trade Bitcoin. If you're only a stock guy like me, then don't worry about it. But there's a few fundamental reasons that should push Bitcoin higher, including a second round of these stimulus checks. They all got to go somewhere, right? They could go back into stocks, but you know, stocks was the last thing. It's old now, even though it was just what, a few months ago. But with this Bitcoin breakout, these cryptocurrencies are looking to become popular again. And I already see it all over my Twitter, everyone talking about it. And no, I'm not back on Twitter. I'm still officially off. But once in a while I check in just to see, you know, what VCs are bragging about themselves and what stupid stuff people have attached onto. But Bitcoin and cryptocurrency seem to be the things to watch, especially because there is more talk about inflation and our debt getting blown out of proportion. So what happens when people lose faith in USD, the US dollar, they look for alternatives. And that's always been the big push of Bitcoin, right? Oh, it's not controlled by any government. You can't print its value away. All true things, but that might be some of the push back into Bitcoin. You would also think that's some of the push back into gold. Gold has been on a tear recently, and a lot of you have asked me to talk about it. It's put in its best year-to-date returns in 30 years this year. It's this orange line right here, just going up. Now, of course, eventually it'll turn around, but the macro fundamentals support it going much higher from here. So this gold precious metals trend is solid. And we actually have a framework that we use to look at gold. It's called RED. The R is for relative size, E expected real returns, and D demand. So relative size of the gold market, what's that mean? Well, less than 15% of the gold mined throughout history is held in investment form. And gold's total market cap is somewhere in the ballpark of $1 to $2 trillion. But the global capital stock, and think about what we're talking about here, it's supply and demand again. So supply is between 1 and 2 trillion. Global capital stock, which is demand, is in the realm of 250 to 300 trillion. So that's a nice supply demand imbalance, right? But what makes people actually want to buy gold? Well, that comes down to expected returns, which is the E in red. So the willingness to hold a stock of gold depends on the rate of return available on alternative assets. So it's all relative. So like it says here, the attractiveness of gold is relative and demand only becomes positive, meaning people want to buy it, when the expected real rate of return on other assets like stocks and bonds is low. So if people aren't liking what stocks and bonds are doing, then they start looking at gold. And remember, with gold, you're not trying to focus on the supply side of the equation because the new flow of gold is tiny in comparison to the existing stock. So really, you just want to focus on demand right here. That's the D of red, because that demand is many multiples the size of the existing gold stock. stock, which is fairly inelastic, which means it's not really changing. So because that supply is so fixed, slight changes in asset preferences mean huge moves in the price of the metal. So if those demand preferences of whether people want gold or not is driven by the real returns of the other assets, stocks and bonds, then that's why gold is going to track yields on bonds very closely. So when the real yield offered on bonds is trending lower, meaning people are getting less of a return from bonds, then gold prices are going to go up, and vice versa. So the whole thing can be boiled down to two key points of how you should analyze gold. Over the long run, and this is one of Dalio's principles too, the price of gold is going to approximate the total amount of money in circulation divided by the size of the gold stock. And if you notice a trend here, whenever we're talking about markets, we always go back to the basic supply and demand. And what do we always talk about with liquidity, right? Liquidity is the amount of money in circulation. So if there's high liquidity, then all that money is chasing after fewer and fewer assets, whether it's gold, stocks, bonds, whatever. That's what causes the price to go up. That's the key here to simplify things. So most people think it's either inflation or deflation which is driving the price of gold, but it's not. The real driver is the expected real return from other long-term financial assets, in particular equities. So there you go, a super long explanation of how to value gold. And if you want to dig deeper, remember all this stuff is on macroops.com. That's our global macro research firm, and a lot of it is free too. It's nice. Now this bull market that we're seeing in gold is coinciding with the worst 10-year rolling returns from commodities since the 1930s. So commodities are in the dumps. So no one knows when this deflationary regime is going to end that's sending these commodities lower, but when it does reverse, we're going to see huge trends in the space. And when I talk to Alex, who's our head researcher at MacroOps, he thinks that everyone is going to be out of stocks and Bitcoin and everything because the real trends and the real returns, the real volatility is going to come back in commodities, like in the old days, like when Commodities Corp was a thing. We'll see. Bank of America recently pointed out that the all-weather portfolio, which is this portfolio made up of 25% stocks, bonds, cash, and gold, evenly split. Well, they just saw the best 90-day returns in history. You can see this huge pop right here. So we're likely at the as good as it gets point with this asset mix. So then you got to ask yourself, what's the pain trade? And the pain trade is the move in markets that you're looking for that is going to ruin the most amount of people, because that's how the market works, right? It's trying to bend everybody over, not just AK. So if there's one thing the market could do right now to defecate in the herd's Cheerios, it would be to spike yields. And you don't even need a large jump, you just need a 75 bips move. And that would be enough to kill growth and all weather and explode volatility across all assets. And Bank of America has an interesting chart here where they use the semiconductor index as a bellwether for growth. And that index is currently discounting ISM levels of over 60. And ISM has a strong correlation, often a leading one, to yields. So as ISM heads higher, so do yields. So if ISM does rise above 60, like the semiconductors are pricing in, then we're going to see that yield pop too. And then that's when we got to watch out for volatility again, which wouldn't be surprising given we have the most complacent positioning in the options market in 20 years. So you can see this red line for the put to call ratio. It's hitting lows, the lowest level since fall of 2000. And the put to call ratio is how many people are buying puts versus calls. If someone's buying a put, they think the market is going to fall. If someone's buying a call, they think it's going to rise. So if this number is small, then that means there's a lot more calls being bought than puts. People are too bullish, too complacent. And Citibank has an indicator showing that the risk of an extended bear market is increasing. So the way it works is that an imminent bear market signal is triggered when the amber and red combined readings rise over 50%. Right now, if we look, the total warning percentage is 40%. But you might remember this chart because we shared it maybe a month ago. And at that point, the total warnings were only 25%. So it is rising. Could be a bearish sign. So Bank of America has a lot of good research. Here's more that they released. So a lot of the bearish narratives that everyone had in Q2 of the Democrats sweeping elections, the end of globalization, Japanification, and the narrow lockdown leadership of growth stocks, that's all morphing into bullish narratives now. And the only reason to be bearish is that there is no reason to be bearish. Now the positioning isn't super bullish, so this isn't really the big top that we'll experience, but we're pretty much at that peak stimulus point. So it's hard to see financial conditions getting easier in July and August. So we could see a nice dip in risk assets this summer, probably in August. Now investors aren't able to hedge the inflationary risk of all this stimulus by shorting bonds. So instead, they're crowding into shorting the US dollar because they think it's going to be debased, or going long gold. So the narrative is shifting to focus more on the dollar because of all the excess debt, the insufficient growth, and the maxed out monetary and fiscal stimulus. Now, one more chart adding to this whole complacency thing is the MOVE index. And the MOVE index is basically like the VIX for bonds. So it shows the risk sentiment in fixed income markets. And right now, as you can see here with this red line, it's hitting all-time lows. Lots of complacency in fixed income. And the person who created this index said that it's rare when you have a low move, which is this index, a flat yield curve and tight corporate spreads, it's rare that you don't see bothersome market conditions following. So So it's once again adding more evidence that, hey, things are too complacent right now. We're due for a bout of volatility. So overall, the bull market is still intact, at least in the short term, but things on the fundamental side are getting a little more shaky. Speaking of shaky, I took a nice fat loss on the NASDAQ. And this is one of the strategies that I use called alpha rotation. And the strategy had me go long the NASDAQ on July 21st right here. And you can see that was pretty much the top, at least the short term. And prices collapsed from there, and I ended up getting stopped out right here on the 24th. And of course, as soon as I get stopped out, the thing starts rebounding again. So I got in at the top and got out at the bottom. At least that's what it feels like. And it was a nice little hit to the portfolio. It sucked, especially after all these gains for months on end. And I knew when the system was telling me to get in, I'm like, really? Right here? This thing is definitely going to turn around. And sure enough, it did. But here's the thing about systems trading and following your strategy. Even though I felt like the market was going to turn around, and it did, and I did get stopped out, there's been many other times where I thought the same thing and was completely wrong. So when it comes down to it, who are you going to trust? Your back-tested system that's been working, or your emotions while you're looking at the market that day? The answer is always trust your system or strategy. And that doesn't mean the thing is going to win every single time. There's no such strategy like that. Otherwise, we'd all be billionaires. But you got to go back to remembering that, hey, I'm playing this over a full cycle. So I can't say, oh, this system is broken and it's trash just because I had one bad trade, because this is the same system that completely avoided the March crash and also caught that historic bond move. We made so much money. So at that time, which were the last trades we took, it felt like we were on the top of the world. It felt like we would never lose again, which is always what it feels like in the market when you're winning. And then sure enough, you're going to get kneecapped. And I shouldn't say kneecap because we had strict risk control on this. So yeah, it was a loss, but the whole point of the system is that risk control so that loss is manageable. We're going to be just fine. But even though we're going to be fine, of course, emotionally, it feels bad. So that's why you keep reminding yourself of what you're doing with your long-term strategy and system, and your goal is just to execute. So even though I lost on this trade because the thing fell, really in the grand scheme of things, I won, because even though my emotions were telling me, hey, don't get in right here, I still got in because I still followed the strategy. And even though I knew I had that feeling that this was going to be the low and it was going to turn, I still got out because my risk point was hit. And that's really the discipline you need to execute and to put your emotions aside. Because if your system has an edge and it has a positive expected value, then over the full cycle, you're going to be profitable. And that's the whole point of building these strategies and systems and using them. Another thing that helps is that all these strategies I use are very hands-off. So yeah, it sucked on the day of, but I made my trade, got out, and then I was away from the market, so I immediately felt better. The worst is when you sit there and look at the thing and dwell on it. You never want that. That's why I like the hands-off systems, low activity. Sit in the trends. That's how you make the money. And again, we talk about all this stuff in this training. There's a link in this video and down below in the description and comments. This isn't going to teach you a strategy that wins 100% of the time, because that's not how the market goes. And no one has that, and whoever says they do is lying. But it teaches you how to control your risk and how to take a loss, because that's just as important, or even more important. Actually, it's way more important than taking those winners. So definitely check that out. It's free. Link in this video, down below in the description and comments. And make sure you subscribe for more of these market reviews. We do them every week. Do that, and I'll see you in the next one. Stay fallible out there. Bye.